Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to class. Remember, class is still in session because the learning never stops. And so this is part 3 of a 4-part video series. We're going to talk about at-risk limitations. And just to kind of give you a little bit of a recap here. So as we talked about in the previous video, video 1, and again, if you've not watched video 1, my recommendation would be that you go watch video 1 and actually kind of review what we were talking about overall. But in case you've watched the video, maybe you haven't, I haven't watched it in a little while. Basically what we've done is that what we talked about is what we call the 3 leaky buckets. And the 3 leaky buckets, as they are depicted out here, is going to be the basis limitations, which was the subject of video 2. If you want to take a look at that video, go ahead and take a look at the link up above. And then today's video is going to be the at-risk limitations, and then we've also got these passive limitations, which will be the subject of the next video. And so I'm just going to go ahead and just kind of kick us off on this. Basically, what we have to deal with risk limitations. Now, as we talked about in the past, you have basis limitations that could take effect. That's going to prevent you from being able to take the losses that you have in an activity immediately. Now, does that mean that you're not going to be able to take the losses at all? No. What that basically means is what you're going to have to do is you're going to have to hold on to those losses. They're going to be suspended, and then they're going to go forward until you can take them later on. When we talk about at-risk limitations, obviously one of the things the IRS gets a little bit concerned about is when people are able to take losses on activities that they're participating in without having sufficient risk in those losses. And if you think about it, it actually kind of makes a little bit of sense why the IRS does this. Because if you don't have any risk in the activity, why should you receive a benefit as a result of it? And so that's kind of why they've done it. Now, the way the IRS wrote this in is that it goes up to Code Section 465. That is Code Section 465, which actually deals with the at-risk limitation. Again, these, just like they with all the other limitations that we have, the limitations are actually calculated at the partner level. And so what ends up happening is when we're preparing the partner's individual tax returns, we have to examine the risk limitations that are going to take effect. What you're going to notice about that, what that means is that there's not going to be any risk limit calculations that's going to be done on the partnership tax return itself. What will happen is the partnership tax return gets built, a K-1 gets sent over to the partner takes it to their CPA, if it's a different CPA, which in many cases that will be the case. And then the partner has to kind of make a determination as to whether they're going to be able to allow them to take the loss or not, based off, or at least if it's going to pass from this leaky bucket to the next leaky bucket, which is going to be the passive limitation that takes place. And the at-risk amount, generally what it is that it's going to be whatever you've invested in the partnership, but it's going to be modified by various things. And I put out the list of the most common things that are going to affect that. It's going to be increased by the amount of cash that you've contributed, because obviously if the partnership makes a loss and you lose cash, that's definitely a risk of loss. It's going to be the adjusted basis of any property that's contributed. So if I contribute a building and say I bought it for $100,000, it's now worth, say, $300,000. The way the IRS is going to look at it is that your adjusted basis of whatever you paid for that building is definitely going to be a loss. Now, some people, when we talk about about this, they say, why don't we use the fair market value? Because if you think about it, if this building gets lost, as a result of the partnership, they have to sell off assets, and this building is one of those things that gets lost. I haven't really lost $100,000. What I've really lost is $300,000. And again, I think part of the reason why the IRS does this is that it takes the most conservative approach, which is something that we tend to do in accounting as a whole anyways. But what they'll do is that they'll take the adjusted basis of that property and use it. And this actually, one of the things also is that fair market value, if you define what fair market value is, it's the price that somebody's willing to pay for an asset at arm's length transaction, which basically means, it's not how much my cousin's willing to pay for it. It's not how much my brother's willing to pay for it. It's basically somebody else who has absolutely no relation to me whatsoever, that has no idea about anything about me personally, or has any connection to me personally, or has any reason to change how much they would pay for something because of a personal relationship to me, how much would they pay for that very same asset? And that's what fair market value is. And how do you determine fair market value? Well, with real property, it's pretty easy. You go and you go to an official real estate appraiser who's going to come in. They're going to do a full blown appraisal to do that. But it's very subjective, because it assumes a hypothetical that if I'm going to go ahead and I'm going to sell this property, how much would somebody be willing to pay for it? Well, there's a whole host of factors that's going to go into that really can't be done as an objective basis to the level that the IRS would be willing to allow for the fair market value to be used. And so as a result of which, something I've always told clients is that if you don't like the fact that the basis used in the fair market value is not what you'd want to do, is go ahead and sell the property, take the cash from that, and contribute that to the partnership. That would actually get you a much higher basis. But this is one of the reasons why we always say you want to talk to your CPA, EA, or tax attorney when you are actually looking at making a partnership, is because sometimes we'll bring this kind of sort of stuff up, especially if we have a property that is severely appreciated. For example, I had a client once who inherited some farmland way back in 1960 something, and so the farmland at that time was only worth about $10,000. Well, when he was dealing with it in I believe it was 2010, that farmland was no longer $10,000, but was actually more to the tune of about $500,000. And so, because there had been some cities that had grown up around it, and there was a lot of other fair market value things that kicked up the value of that land. And so, we always said that if you're going to use this for a partnership, best to actually sell it, and then take the cash from that, and then take the cash and then contribute that. And so that tends to work out a little bit better. It's also increased by income and gains. So if the partnership starts making money, the thought process is that as a partner you're entitled to that money, and so if the partnership ends up going belly up, what's going to end up happening is that you're going to lose that income and those gains that you have acquired and that you've already paid taxes on. And so the IRS, in order to prevent double taxation, is also going to allow you to allow that to increase your at-risk limitations. It's also going to be increased by a partner's resource debt. Now, if you remember when we talked about this in the past video, where we talked about various types of loans, we had recourse, non-recourse, and qualified non-recourse mortgage financing. Recourse debt is basically the debt is a type of debt that as it's discussed in Code Section 752. The recourse debt is actually debt that you have gone ahead and signed to the bank that says, look, if for some reason the partnership can't pay this debt, I will take care of the debt myself. And that would allow me to have the value of that recourse, which is how much I'm recourse at, how much am I at risk of having to forfeit cash over for if this loan goes belly up. That's what's going to end up happening. And it's very interesting. When I first started working in the CPA industry, and I was working at a few firms, I noticed that a lot of firms that where people are basically taught about various partnership rules, and they learn the partnership rules basically by the way that a lot of CPAs learn things is they work on a tax return, they make a mistake on it, as a result of which the senior manager or the partner says, this is the mistake that you're making on this return, and as a result of which you need to learn from this. And I noticed that at a couple firms that I was working at, they didn't put partnership recourse debt as part of the at-risk limitations, but instead put it as part of the basis limitations. And that's a very common mistake that I tend to notice at various CPA firms, is that people don't think of the recourse debt portion as part of the at-risk limitations, but instead as part of that basis. And then what they'll say is, well, they're going to have a basis limitation because it's, they gave, and the way it was explained to me was, oh, well, if he's got recourse debt, he can, he gets additional basis from that. That's not really the case. You get additional at-risk amounts that you can use in order to be able to take some of those losses. It's also increased by qualified non-recourse financing. We call this in the previous video qualified non-recourse mortgage financing, because qualified non-recourse financing is always going to be done on real property, and so it's generally going to be a mortgage, because what's going to happen is the bank's going to come back and say, okay, we're going to loan you $1 million to go buy this land in this building, but we're going to ask that that you secure the building with us, so that if for some reason the partnership can't pay the debt, we're going to go ahead and confiscate the building. And as I talked about in the previous video, the IRS and Congress kind of came to the conclusion that it was in the best interest of the United States to allow for this exception for a few reasons. And if you want to, go ahead and take a look at those videos, and we can go that into greater detail. Obviously, at-risk amounts are going to be reduced by distributions, and part of the thought process is, well, if I put in $50,000, but 4 years later I take out $50,000, that amount of my risk is gone. And then, of course, losses and deductions that have been previously allowed under all of these so under the basis limitation, and then at the at-risk limitation is going to allow it. Now, of course, if it's trapped because of it's a passive nature, that is still going to be a reduction of your at-risk limit. So you kind of have to be able to manage some of that and put that together. The reporting of the at-risk limitations. Now, if you remember what we talked about in the previous video, where we said, hey, look, basis actually doesn't get reported on a specific tax form, and that's not the case with at-risk limitations. Now, why do they not force you to report basis on a tax form, but they require you to do it at risk? That's just one of the big mysteries of the universe. You're just not going to be able to come to an answer with that, just because, for a variety of reasons. But essentially what ends up happening is that, we have to report the form 6198 at-risk limitations. Now, the IRS requires this form when there is an at-risk limitation. So, if there's no at-risk limitation, no form like this gets filled. Now, some practices, and I didn't actually work at this practice, but I know a friend of mine who actually does work at this practice. They will actually force that every single time there's a K1 that gets produced, they will produce this form, which is a 6198, and if it is a passive activity, they'll also force the other form, which is the 8582, to get printed, just so that there's a document that says that we kind of looked at this and made a determination that there was no risk that was actually done. It doesn't cause any harm to send this to the IRS when it's not required. In my personal opinion, I think it's a good idea to do so. I haven't activated it on our firm, just because I know I have a lot of clients, especially those who have, I have one client who has, somewhere in the neighborhood of about 15, 20 K1s. And if we ended up adding, 6198 forms and 8285 forms, or 8582 forms, their tax return is going to get to like 600, 700 pages easily, and just to save on paper, save on client grief, we tend to do this. Now, you'll take a look down here, and there's two different ways that you can do the calculation on this, and there's the simplified at risk, and then there's the detailed at risk, which your situation is going to dictate which one it is that you're going to do. I'll be straight. Usually, when we fill out these forms for our clients, we actually don't make a determination which one that they do. We let the software kind of determine that, because if we can do something simplified, we're going to do it simplified. But if there's a reason why we want to do the more complicated one, that we're going to just do it through the complicated version if that ends up happening. All right. So then the next thing that we want to talk about, okay, your application of your losses. If you do have a loss that's at risk limited, what's going to end up happening is it's going to be suspended but carried over until you have sufficient risk in the activity. And then once that ends up happening, you have income or gains to cover the carried over losses. You're going to be able to pick that up at that time. So once again, taking a look at this, these are our three buckets. Again, if you've had basis, if your income or if your losses go through this and you have sufficient basis, what's going to happen is that it's going to leak out and it's going to come over to the at-risk limitations. And then if you have sufficient risk, it's going to leak out and head over to the passive limitations. I would highly recommend that you watch our passive limitations video in order to be able to wrap up this series. I think it'll work out very well and very nice for you. And if you have any questions, feel free to reach out to us. Basically, what I'm going to just say in closing, thank you very much for coming here. Remember, my name is Kevin Matthews. I am the tax professor. I want to welcome you back to class. Class is still in session because the learning never stops. If you like this video, go ahead and please do me a favor and hit the like button on the video. We'd like to get our likes up because, you know, and it shows an appreciation for all the stuff that we're doing with this. And then if you like the series, I would actually highly recommend that you actually subscribe to our page, because you'll be able to come out and you'll be able to see when we're having more videos come out. I've actually had a couple people who did watch one of our videos because they saw that it got released, because we went ahead and we once we released the video, immediately it came up and said, hey, I loved it. And then I've had a couple other people who have sent me emails on the private side that have said, hey, look, we really liked your video, and very gracious for you to have done that. And that means a lot to us, because I don't do these videos simply because I love talking. I do these videos because there has been a lot of times in the past where clients and of course my students, because I do teach at a university, have come to me and said, hey, I don't understand X, Y, and Z. You know, basically what I'll say is, you know, if you want to, go watch the video on this. I'll give you kind of a synopsis of it, but if you go watch the video, you're going to get a much broader detail as to what's going on with that. So again, we want to say thank you very much for watching, and hopefully we'll see you again. Thank you.